Do you realize how important realization is to the income tax? I'm Allison Christians.
And I'm Leandra Lederman, and it's time to break into tax.
Realization is a really simple idea on the one hand. It's just a trigger to say, oh, wait a minute, you have to think about your income tax right now. Something happened. When you work for a paycheck, receiving the paycheck is the trigger, realization of income. But what if you get paid in stock? The moment you get paid, you own something, but now the stock goes up. Did you get paid a little bit more when the stock rose in price? No, because of the realization idea.
At one point, the US Supreme Court suggested in Eisner versus Macomber that realization was a constitutional requirement, but it's well accepted that it's something that simply makes the income tax more administrable. Because if we didn't have a realization requirement, the idea would be that paper gains and losses could be taxed on an ongoing basis. And we have that mark to market in some limited contexts. But if we didn't have the realization requirement, then what that would mean would be that taxpayers would be getting deductions for those paper losses. And it would take a lot of enforcement resources for the IRS to audit taxpayers to really assess what is the value that the taxpayers' assets actually have. It's much harder to establish the amount that should be subject to taxation if you don't have some triggering transaction. So usually what triggers realization with respect to a gain or loss is some kind of disposition.
As soon as you realize that realization is a trigger, then you can imagine that taxpayers are going to spend time balancing. I want the trigger, I don't want the trigger. So I'm going to do things to trigger in some cases, for example, if I might have a loss, and I'm going to wait, I'm going to hold off. I'm not going to pull the trigger if I have a gain.
In the US system for gains and losses, the realization calculation is in Code Section 1001. It's on the gain side, the amount realized less the taxpayer's adjusted basis produces gain realized. And on the loss side, it's flipped, that the amount by which the adjusted basis exceeds the amount realized is the loss realized. So Section 1001 is just a mathematical calculation. It tells you the amount of the profit or loss that the tax system has deemed to have occurred. And then recognition is how much you'll actually be taxed on of that. When do you apply Section 1001? You have to have some kind of sale or exchange or other disposition.
In Canada, we have proceeds of disposition where you have a sale or exchange or other disposition where you go and you just do that mathematical calculation, just the same as in 1001.
The Treasury regulations in Section 1.1001-1A talk about exchanging for something materially different in kind or extent. So you have stock and you exchange it for cash, or you have stock and you exchange it for a painting. Those are examples of realization events, and we have a market transaction typically. And so it makes the tax much easier to administer than if we simply said, well, we're going to have to value everybody's stock holdings, whether they're publicly traded or not, at the end of the tax year or on their birthday or something like that.
You have a great paper that talks about this valuation issue, which we'll link in the description below.
One important concept for students is that realization is a necessary but not sufficient condition for taxation. It's a prerequisite. You have to have that in order to have recognition, meaning it's taxed, shows up on a tax return, but it's not in itself a sufficient condition because you still might have some kind of non-recognition provision applying even once there's realization. You also have the same issues on the loss side, that just because you have a moment where you realized a loss, that does not necessarily mean that that loss is recognized.
Exactly.
It's not necessarily deductible. And that's particularly true for, at least in the US system, for individuals. You realize a loss on the sale of your personal residence, or your personal car or some other personal asset, well, individuals' personal losses are just not deductible. They're not authorized.
The taxpayer's desire to trigger losses, to trigger realization of losses, is exactly what leads you to a bunch of loss limitation rules, right? So it's the fact that the taxpayer has control and they can trigger the loss and then, maybe buy the stock back again the next day. So we need a wash sale rule, right? So we need a loss limitation rule. We're cabining things. When you're thinking about realization, the intuitive moment when realization matters and is when you're thinking about something that has been rising or falling in value and you exchange it. And that's why we often associate realization with gains and losses. But realization through exchange or disposition of an asset is not the only way to realize income in an income tax. There are these other ways as well. For example, a cancellation of debt can be a trigger, a realization trigger, because the obligation to repay is no longer there. And that's the trigger that says, oh, now you have to realize that income, which is the money you got from the debt you no longer have to repay. So with a deduction, it's the flip side of an income item. On the income side, you have received or accrued. On the expense side, you have paid or incurred. If you're an accrual method taxpayer, as soon as you incur an obligation, realization, you go look for that deduction allowance. Sometimes you can see realization pop up in unexpected places. For example, an imputed interest charge on a loan that is zero interest or too low. You might think that's an anti-abuse rule, and it is, but it's also forcing a realization of a return before the end of the investment. You're going to start to learn about patterns in an income tax class, and this is just one of those patterns. Oh, something happened. Does it trigger realization? And then you'll train yourself to say, okay, but realization is not recognition. Realization is a moment where income has been created in the sense of an income tax, but it doesn't necessarily mean that tax is owed right away. So then you're going to go look for those exceptions to recognition. And I think that's pretty universal. You might see different words in different income tax systems. We don't necessarily use exactly the same terms in Canada as we do in the United States, but the idea is very consistent across systems. So we actually had a lot to say about realization, but we didn't want it all in this video for those just trying to break into tax. We've added some more to a second video that's an extended version of our conversation. You can see the link in the description below. As soon as you realize how much value we are bringing to you as you break into tax, I hope you'll like our videos and subscribe to us on YouTube.